Welcome to EIS Navigator, the podcast for UK venture capital. I'm your host, Brian Retta. Today we continue with our basic series, and today we're going to talk about venture capital trusts and give you an introduction to what they are. As a reminder, as well as the audio podcast version, you can see a video version on YouTube as well. And today I'm delighted to be joined by Nel Isaac, who is a senior manager for strategic partnerships at Foresight Group. Welcome to the podcast, Nel.
Thank you very much, Brian.
So we had one of your colleagues back on the podcast way back on episode 47, which seems like a long time ago.
Oh, really? Who was that?
Andy Floxam, I think.
Yeah, it would have been, yes. Yeah.
So yeah, but if anyone missed that or doesn't know who Foresight are, do you maybe want to tell us briefly who they are and what they do?
Yes, of course. So Foresight Group are a private equity and infrastructure investment manager, and we manage around 13 billion of assets on behalf of institutional clients and retail clients. So I work in the retail fundraising team, which is predominantly high net worth clients who invest via financial advisors.
Yeah. Excellent. And yeah, as one of the largest managers in the space, I think you're probably pretty well placed. You have 4 VCTs, I think.
Yes, that's correct. So 1 open at the moment, and the other 3 due to hopefully open towards the end of the year or beginning of next year.
Today we are talking about venture capital trusts, VCTs, and I think probably a good place to start is just saying, well, what is a VCT?
What is a VCT? Yes, or more formally known as a venture capital trust. So it's a company that is listed on the London Stock Exchange, and it invests into lots of small early stage businesses, and it holds these investments for several years, helping them grow while gradually adding new ones to the portfolio. And it was an incentive created by the government in 1995, so 30 years ago. And the idea was to, and is still, to encourage investment into small, early stage, high growth businesses by offering tax incentives to the end investor.
Yeah, and I think, the stats showing that it's been pretty successful at that, actually.
Yeah, definitely. I think 3 billion has been raised in the last 3 years for VCTs.
Yeah.
So becoming a really kind of popular strategy.
Yeah.
And I think it's really amazing as well that some of the companies that started off with funding from VCTs have grown to be kind of household names in themselves. So some companies that people might not know were originally funded by VCTs like Zoopla, Virgin Wines, Grays, Fevertree. Some have also achieved listing on the London Stock Exchange, and some have also been sold to big brands like Microsoft, Amazon, for example. So really important component to the UK economy.
Yeah. So you mentioned a few examples there of sort of companies. Maybe you want to tell us a little bit more about the sorts of companies and because there are some restrictions as well. But tell us a bit more about what a VCT actually invests in.
Yeah, so there are some rules around, firstly, what qualifies for VCT investment. So the first thing to note is you've got qualifying holdings within a VCT and then also non-qualifying holdings. Mm-hmm. So 80% of the VCT needs to be in qualifying holdings, which is typically small, high-risk UK companies.
Mm-hmm.
And then the other 20% can be held in cash, listed equities, or other listed instruments, or liquid assets, essentially, to manage the liquidity and running costs of the VCTs. And yeah, there are lots of rules from a VCT funding perspective, and then from the company's perspective as well.
Mm-hmm. Yeah, and I think some of those about so there's a maximum amount you can put into a company. There's maximum company size.
Yeah, exactly. So to be eligible for VCT funding, the company has to be unquoted or listed on AIM, but not the main market, have gross assets less than 15 million before investment and less than 16 million immediately after. has to have fewer than 250 full-time employees, and it has to have been trading for less than 7 years, or less than 10 years if it's knowledge intensive when it receives its first VCT fundraising.
Yeah. And for those who maybe watched the earlier episodes, these are the same rules actually as for EIS. So.
Yeah, exactly that. And then in terms of the VCT itself, so a VCT can invest up to 15% of its money in a single company, but each company is allowed to receive up to 5 million of VCT or other tax efficient funding in any 12-month period, with a cap of 12 million over its lifetime. And then the final thing to note around the rules is that managers are required to invest at least 30% of funds raised in qualifying holdings, which I mentioned, which is 80% of the portfolio needs to be, within 12 months after the end of the accounting period.
Yeah. So I think some of those things matter. So, one of these, so I think the great thing about VCTs is that you get a diversified portfolio. You can't just, it's not that you buy a VCT and you get 1 or 2 or 5 companies, you get a diversified portfolio. And when you give them cash, they're not going to just sit on it. They are actually going to deploy the money because they have to.
Yeah, exactly that. And I guess that's the main differentiator from an EIS, for example, is that with EIS, investors hold shares directly in the underlying company as opposed to the actual VCT itself.
In the market, I think there's various different strategies that VCTs use. You maybe want to sort of summarize some of the top level strategies that we see.
Yeah, so there are 3 types of VCT strategies. The most common type is a generalist VCT, and that invests across a diverse range of sectors. So it could be technology, healthcare, consumer and services. And the aim of a generalist VCT is to balance growth opportunities with sector diversification to manage that risk. Then AIM VCTs focus on companies quoted on the alternative investment market. It's quite self-explanatory. And then you've got your specialists, so sector-focused VCTs as well. And as the name suggests, it concentrates on a specific industry like healthcare or technology. So it can be slightly more risky just from a single sector perspective, but you could expect higher returns from those types of VCTs as well if that sector performs particularly well.
Yeah, I think it's probably fair to say they were probably more common a few years ago than they are now.
Yeah, I think when we talk about traditional VCTs, that's what we probably talk about, whereas now they tend to be more generalist and diversified across different sectors for that balance.
And it's probably worth mentioning legacy strategies as well, because it's not a big factor, but I think that it's still a noticeable presence in some VCTs.
Yeah, so it's probably worth just talking about some of the investment strategies a VCT fund manager uses to structure a portfolio, and that can also vary. And that's where we probably talk about some of these legacy strategies. So some of the strategies they use are early stage growth investing, so backing young, high growth businesses, and they tend to be high risk, higher potential returns. And that's probably slightly more similar to an EIS. Then you've got later stage scale up investing. So investing in companies that are already generating revenues and then want further capital to grow. So they might be slightly lower risk than your startups. And then follow on funding, which is investment into existing portfolio companies to support scaling again. And then, as you mentioned, so managers used to be able to finance management buyouts or acquisitions within VCTs, but rules were put into place in 2015, so 10 years ago, to prevent these types of deals from happening, because the government decided that money had to be used for growth and development of these businesses as opposed to restructuring the ownership. But yeah, some VCTs, and we have some VCTs that still hold these types of investments, the MBO structured deals as well.
Yeah, and it's fair to say, I think if we looked at the sector 10 years ago, you would have seen a lot of those a lot of those deals have exited. So in most of the VCTs, I know in your case, there's some, it's a small proportion of the portfolio. For some managers, it's still meaningful, but, nowhere it's a minority. Most of them work on the current rules.
Absolutely.
So you mentioned all strategies, and you also mentioned EIS. Do you want to maybe just say how the strategies in VCT compare to strategies in EIS funds?
Yeah, of course. So I think I alluded to it, but with EISs, these are often earlier stage or scale up businesses, and sometimes in more kind of specialist areas as well. And the strategy is all about growth, aiming for kind of a few big winners that drive overall returns, whereas VCTs, they've become kind of more balanced, aiming to deliver income and kind of balance it that way with the different type of strategies and the diversification within the fund as well.
If someone's listening to this think, oh, this sounds good, I want some of these, how might an investor go about buying shares in a VCT?
Great question. So VCTs regularly raise new capital by launching an offer for subscription, or they might call it an open offer. Most VCTs, or a lot of VCTs, tend to do this annually. And depending on the VCT, depends on the track record, so how long they'll actually be open for. So for example, one of our VCTs was already closed within 8 days last year. So just to give you an example, so an investor can apply directly through the VCT manager, ideally through a financial advisor, or on a platform.
And I think it's fair to say you can also buy shares in the secondary market, but that's less attractive.
It's less attractive because you don't get the tax reliefs, but you can do that, yes.
Yeah. And if anyone's wondering why we're not talking about tax reliefs, they are coming in the next episode. So we'll just preview that. So we know how investors can put their money into VCTs. How do they get their returns from the investments?
So the main purpose of a VCT is the dividends and the tax-free growth. Most VCTs aim to pay a regular dividend, usually of between 3 and 5% annually. And these tax-free dividends paid by VCTs can obviously be attractive to a lot of investors as an income-generating vehicle, especially if they're approaching retirement, for example. And then the other side of it is the upside potential, so capital growth. If the underlying portfolio performs well, so they grow and exit successfully, some of these companies, the VCT's net asset values will rise. But in practice, most VCTs focus more on the income and the dividends rather than the capital growth.
Yeah, and I think sometimes if a VCT gets a really good exit, they're more likely to pay special dividend.
Exactly.
And if an investor wants to sell their shares, what's the sort of process for that, and what's the mechanisms?
So selling VCTs can be tricky because secondhand shares don't come, as we just discussed, with the upfront tax relief. So there isn't much of a market for them. So to help with this, most VCT managers offer a buyback facility where they repurchase shares from investors at a small discount to the net asset value. And this is usually around 5 to 10%. That's the kind of market standard. And this is via a market maker as well. It's worth mentioning that buybacks are not guaranteed. So that's going to depend on the VCT having cash. So it's important to look for managers with a solid track record of supporting buybacks in their strategies.
Yeah, and certainly VCTs state their buyback policy. And some of the restrictions are stock exchange enforced because there's closed periods and
exactly that. There'll be open and closed periods throughout the year, as you say. So usually what an investor would do would register their interest with a market maker, and then we'll have open and closed periods where they can facilitate the buybacks.
Yeah, and I think it's fair to say that buybacks are small but steady is the way I would describe it in the market. People seem to hold these things for some time.
Yeah, definitely. Well, holding it for at least 5 years anyway.
Yeah, certainly that. But yeah, I think people tend to hold them for a lot longer than that.
Yeah, they do.
Yeah. So, thanks very much for all that great introduction. If anyone wants to find out more about what you're doing at Foresight Group, where should they go?
They can go to our website, which is Foresight Group. You can find information on all our 4 VCT strategies. As I said, 1 is open at the moment and the other 3 opening soon, hopefully. But you can also contact me if you want any more or any further details.
So we'll post links to that in the show notes, along with links to some of the formal documentation on VCTs. So thank you very much, Nel, for giving us such a good explanation of what VCTs are. So for listeners and viewers, as usual, you can get full show notes with links at harmonandco.com/podcast. You can subscribe to the podcast on all good podcast services and players, or following the link to show notes, and you can also follow the series on YouTube. If you like what you hear, then please tell a friend or a colleague, give us a review in your favourite podcast app, give us a like on YouTube. We can be found at inquiries@harmonandco.com. Thanks for listening, and we'll be back next week talking about the VCT tax release.